Hello. Today we will be talking about installment and revolving credit cards. So the first thing we need to know is the definition of installment credit and revolving credit. So installment credit is loan for a fixed amount of time, and you have to pay that money back in that specific amount of time. So the examples here are student loans, mortgage loans, and auto loans. So basically, you have either a 1 month payment or 1 month payment or whatever specific time frame that you have, and uh, you get interest for that month. So let's say that interest is let's say it's 0.1%. On the second month you have to pay, that interest is going to be compounded to a number, and then you're going to have to pay a little bit more than 0.1% interest. So the number that you'll be compounded by is there. So that's installment credit. You have to pay in a specific amount of time. Revolving credit is credit that allows you to repeatedly borrow money until a set limit and pay back over time. So one example of this is a credit card, and another example is lines of credit. So this means that, let's say your set amount is $55,000, right? Let's say your set amount was that. So if you borrowed money to up to, let's say, $30,000, you have to pay that money back somehow, and then if you don't pay it back in a good amount of time, the interest rates could go up drastically, as we can see in our comparisons below. So let's start with our comparisons now. So installment credit has a payment plan, meaning you have to pay back by a specific amount of time as seen up here, right? But revolving credit has no set payment plan. So this means that installment credit, you're going to be more strict. You're going to have deadlines to pay it. So you're going to have probably deadlines by each month in January, February. Probably the end of the month, you're going to have to pay a specific amount. So you're going to have to pay let's say $1,000 in January, and then you're going to have to pay the $1,000 times whatever the interest is plus, let's say interest is I, and you're just going to have to pay the interest plus 1. And then this interest gets compounded monthly if this payment is monthly. And then revolving credit, it has no set payment plan. So you can pay it back in let's say January, and then you just make a payment in the middle of March, and then you have the amount of money slowly builds up until you reach the amount that you have to pay back. And this interest is also compounded.